Folks, the market just hit brand new lows. Yet somehow this number popped up today. $24,779,578. That is how much money Househack has raised in 21 days as the stock market has hit new all-time lows. I'm nearly in tears, and I'm super honored that at the bottom of the freaking market, y'all trust me enough to take Househack to the moon. So I'm honored. If you don't yet know about it, go to househack.com. If you're accredited, stay tuned in January for non-accrediteds. All right, folks, look. This is probably the worst stock and bond market that we've had in quite a while. It certainly is the worst bond market that we've had ever since at least the 1970s, but some people literally go as far as saying ever. That's because when we take a look at the blue chip bond market, look at those blue lines over there on the far right side. See that big drawdown over there? Yeah, that's a drawdown in bonds. These things usually don't go down that much. I mean, people who have like that balanced 60-40 portfolio are just getting screwed. Bonds are getting absolutely reamed in this market, and we're going to talk about some major credit stress that's actually happening in the market right now and what it could mean to us. Why are we seeing reverse repos, by the way, skyrocket? Let's talk about those as well. Then we're going to talk about what's going on with the Eurozone. We'll talk a little bit about London, and we'll talk about my thoughts on all of this, and of course, it all has to do with the Fed. But first, it's worth noting that yes, the Nasdaq has officially hit brand new lows. Take a look at this, folks. The Nasdaq finally broke the lows that we had on June 16th, and we are finally below the 0% on the fib line, breaking lines again. Last time we had lows that we broke was this yellow line over here, where we bounced off of this floor once, twice, 3 times, 4 bounces over here. And that didn't matter. We still ended up dropping another like 15% from there. And now we just broke the floor again. So could be a little bit of a bad omen. Certainly one that'll create some anxiety. Not so good. And anxiety is exactly what companies like Nike and Carnival Cruise Lines felt today. Nike down 12.8%. The biggest one-day drop since 2001, folks. That's 21 years. In 21 years, Nike has the biggest one-day drop. It's so bad that the volume candle is almost touching how low the bar went today. If you're into TA, you know that's a bad day. Carnival Cruise Lines did no better. Worth mentioning that course members and I did a deep analysis on Carnival Cruise Lines and other cruise lines for about 2 or 3 days in a row about a month ago. And we decided, well, not that I could speak for everybody collectively, but I certainly decided not to touch these with a 10-foot pole given how much debt they have, but also advertising uncertainty. I read the earnings. Look, they told us about this advertising uncertainty in the last earnings report, and I'm like, there's no way I'm putting money into the cruise lines right now. Thank freaking God I didn't. Anyway, the earnings report today from Carnival, same thing, folks. You know what they said? We're going to double down in the second half of the year on advertising. That's what they say on one part of the earnings report. And then on the other part of the earnings report, they're like, we're going to try all these new strategies for advertising. And I'm like, oh my gosh, you're basically telling us you have no idea what you're doing, but you're going to spend more on it. And I'm like, this is horrible, especially with all the debt y'all have. I don't know. But anyway, that's what kept us away from them. By the way, like if you're not part of these course member live streams yet, you're missing out a lot. This is the kind of stuff we do. We pick an industry, we go deep on a few companies, and we try to learn everything we can about the industry, and then we move on to the next ones, whether it's the casinos, whether it's autos, whether it's EV, whether it's chips, whatever. We're trying to find the best safety that we can, and the cool thing is you could just hit play and listen to me. So join any of the coupons linked down below or courses linked down below, and we do have a coupon code expiring tonight. So let's talk about now what's going on with credit markets, because this is probably the scariest thing right here. Credit markets, for us in the stock market, they're not something that we generally pay much attention to, but I'm talking about it because we might need to start giving some credence to what's happening in the credit markets. So I'm going to simplify this as much as possible. But basically, because you've got JPOW hiking rates so freaking crazy high, and you could basically get a risk-free 3.75 on treasury yields, there are a lot of people who would ordinarily be buying debt, which would be like junk bonds or whatever. Think of it basically like giving a loan to like Carnival Cruise Lines and getting paid 11%, right? That's kind of like a junk bond. Or helping a bank finance an acquisition for another company. So basically, let's just make this up, okay? Let's say McDonald's is going to buy Burger King. And McDonald's is like, cool, we're gonna put $20 billion in, and hey, can we borrow 30 bill from the bank? And then the banks are like, sure, okay, hey, yeah, we can make that financing happen. Okay, good. In the meantime, hey, anybody in the market want to give us money that, you know, and we'll pay you interest, so that way we can charge McDonald's interest, and kind of we'll be like the middle person, we'll collect fees, because that's what banks do, right? Well, the problem is the banks are going to the market right now and nobody's there. Like, they literally just had a massive $3.9 billion deal canceled. This group called Apollo Global Management was going to do a $3.9 billion buyout. And the banks are like, we have to cancel. Like, we're pulling out. And banks never pull out. Like, they're pulling out because they can't get investors. Like, they just don't have the cash. And you're like, well, where is all the cash, Kevin? And you look around and it's like, it's either people don't have it anymore because they lost it. People are investing into house hack because they're really smart. My opinion, no guarantees, okay? Or it's in the reverse repo market, which is skyrocketing right now. You look at the reverse repo market, which many people heavily misunderstand what the reverse repo market is. But it's skyrocketing. I'll give you a quick little glimpse of what the reverse repo market is. But this is it. This is what it graphically looks like. It's exploding with how much money is sitting in reverse repos. I mean, we're gonna be at 3 trillion in reverse repos soon. We're at 2.4 right now. And what this is this is a place where banks park extra cash they have overnight. And then you're like, well, Kevin, if the banks have the cash, why don't they just finance these deals? Because banks don't like to do that. Banks like to take money, move it around, and collect the fees. But we don't want to risk the banking system and have them take the risk of putting junk bond deals together. Let the market bail those out. And if the market is demanding a higher rate, then that's the market's problem, right? And that's that company, Apollo Global Management's problem. But don't risk the banks. The banks are sitting on a war chest of freaking cash. And this is your evidence that the banks have a lot of money. But it's also a potential sign that because they have so much money sitting around, they're being smart and they're actually not throwing it into the bond market right now to stabilize it, because they're like, no, the Fed's just gonna keep being aggressive and they're gonna keep raising rates. And that's literally what the Fed is telling us. Now, we'll talk more about the Fed in just a moment, but it's gotten so bad that you have Bloomberg authors right now writing articles and talking about things like, quote, this is how it breaks, talking about the financial system. The financial system almost just broke in the United Kingdom. They got margin called, basically. The pension funds were basically gonna go bankrupt, okay? Some of the pension funds were gonna go bankrupt. That's really, really bad. So the fiscal division, I'm sorry, not the fiscal division, the financial stability division of the Bank of England, which is their central bank, is like, oh yes, money printer plays. Oh my goodness, we must solve the problem, as hopefully they did temporarily. But now they set that precedent, which creates a dirty moral hazard that if other pension funds start getting reamed because their bond values are collapsing, then they're just gonna bring out the money printer again. Or it was a wake-up call to these pension funds, and these pension funds, guess what they're gonna do now? They're gonna start offloading two things, folks: private equity and real estate. And this is why I think the real estate market is gonna get absolutely devastated, because all the investors who are going deep speculating on the real estate market are like, why am I holding rental property right now when I could be breaking the piggy bank, dumping this rental property and putting it into the bond or the stock market, right? That's what some people are thinking. That actually creates a massive opportunity to go bottom feeding with house hack, which is why I created house hack, so we can diversify right before a potential financial crisis in the real estate market. This is the perfect freaking time to do this. Like, I like, knock on wood, but I feel like we could not have picked a better time to launch househack.com. But anyway. So, anyway, this is a big issue. I mean, let me show you just some more of these charts, just so you can see what's going on, okay? Here, these are junk yields right now, junk bond yields right now. Look at that, averaging right now 9.71. We haven't seen this kind of demand for a junk bond since the COVID crush, since COVID. And we're not even that far under that kind of crazy spike, except we're just gradually going up. It's absolutely insane. This is triple C rated bonds, like super junk, okay? Absolutely getting reamed in terms of pricing. I mean, you're just getting destroyed with returns over here. And this is the Goldman Sachs Financial Conditions or Tightness Index. It basically tells you like how tight is financing right now. It's the worst that we've seen since also COVID. And I mean, look at that. Not that far off either. It's scary. So basically, like if you're feeling bad and you're feeling panicked, trust me, the credit markets are feeling it as well. And it's worse now than it was in the summer, which is crazy. I mean, JP Morgan preferred stock is down like 30%. Tesla, I don't even think is down. Well, maybe after the 7% drop, it's maybe close to that. But I think Tesla's somewhere around there for the year, you know, and so is the Nasdaq. Nasdaq and actually Tesla, I think, is still slightly outperforming the Nasdaq. But anyway, actually, I can't guarantee that because I haven't looked in the last couple days. But anyway, preferred stock on Vornado Realty. People are like, oh, this is safe, you know, it's a preferred stock. Nope, down 35%. Austria is down like 50% on some of their 100-year bonds. Everyone's losing money. No one's safe. The only people who are like not losing money are the Grinches, the short sellers. But while they're making money now, they usually lose money like 9 out of 10 times. They just happen to be having a party this year. Okay, so what also is going on? Because there are some other crises we got to talk about, okay? Let's talk about those. I do want to say that lifetime access for the wealth course is going away. If you've got it locked in, you keep lifetime access. But if you don't yet have access to the wealth course, we're doing a huge overhaul. It's going to be a huge theme as part of this channel here. It's going to be a really big change. I think a lot of people are going to be really excited about that program. But lifetime access goes away after tonight. So you want to use the coupon code and join that. Lock in lifetime access, because it's going to go to a different model and you're going to be paying way less money for it if you get in today. So just sneak peek, I told you so. But anyway, there is a coupon code for all of the programs expiring tonight. So whether you're looking for property management, rental renovations, learn how to be a real estate agent or how to improve your sales as a real estate agent, now's the time to be a real estate agent. The stocks course, you name it, use that coupon code linked down below. And yes, while I am in the process of being a licensed financial advisor, I'm not a financial advisor. The courses are not financial advice. I'm going to give you all the perspectives that I can, though. Let's talk about Eurozone inflation. So we saw this coming, okay? I warned about this on Sunday and again on Monday and again on Tuesday. I'm like, look, the Eurozone, like these economists suck so bad at predicting inflation, the Eurozone's going to hit double-digit inflation. The estimate was 9.7%, and guess what? It came in at double digits. It came in at 10%. Except the problem was it wasn't just that headline came in at 10%, it came in broad. I mean, euro at a 2-decade low against the dollar. The inflation came in broad to the point where if you look at just core inflation, it's up to 6.1% from 5.5%. You take out alcohol and tobacco, which is a big deal in Europe. Those are Europeans. Oh yeah, I could say that I'm a European. Although I've never smoked a cigarette. Anyway, up to 4.8% from 4.3%. Goods and service inflation, super wide now. And really what you're doing is you're telling central banks you got to keep raising rates. And this is terrible because frankly, people are now like suits are now writing on Wall Street that London is about to lose control of the pound because as the Federal Reserve keeps hiking rates and you get people like Brainard this morning saying we're going to keep going and we won't drop early. We're not going to pause early because we have to get inflation to 2%. We're going to stay at higher rates for longer, get used to it markets. Well, now people are suggesting, 28 out of 30 surveyed economists at Bloomberg are suggesting that the Bank of England is likely to hike rates a full 1% on November 3rd. That's when they do their big rate hike. But only about 2 out of those 30 economists actually think that the Bank of England will do an intra-meeting hike. I believe it was 2. I could be slightly off on that. But anyway, from memory, it was very few thought there was going to be any kind of emergency hike. But that in the meantime, the dollar may as well, or the pound may as well get prepared for rates to rise. But even if the Bank of England raises rates a full percent, which is why we saw some recovery of the pound, if the Fed just bumps up another 75, they're going to relatively look like they're behind again. So a lot of countries around the world are falling behind the hiking schedule of the Federal Reserve, and that's actually why the dollar is so freaking strong. Retail, by the way, starting to slow down. I received an email this morning that retail average year to date, and it's from Vandatrack, has been essentially investing $1.16 billion per day into the market. But that has now fallen to 0.93, so 930 million instead of over $1 billion. Retail's starting to run out of money at the same time as the VIX is skyrocketing and credit markets are falling apart. Boy, my thoughts, I hope you're out of margin. I hope you actually believe in inflation expectations that, next year inflation will actually go down and it won't like plateau at like 5 or 6%, leading the Fed to go crazy on us. But that's really the only reason you should stay in the markets. and stay out of debt, increase your income, do whatever you can. Even if you have to make a YouTube channel and just pitch the fact that you have a coupon code expiring for your courses linked down below, or you've got a house hack investment that you got to pitch, you got to work harder. These are the times of the market where you put your boots on, you strap them tight, and you go, okay, we're just going to go through hell for the next 2 years. But you know what? At the end of these 2 years, we're going to come out of this thing and we're going to go, damn, now we're able to live, hopefully, the dream, and we're able to reap the benefits of the seeds we planted, so to speak. And of course, we're going to be going on a shopping spree with House Hack, ideally when the market bottoms, not ideally before that. Anyway, thank you so much. If you have any questions, make sure to go to Discord, go to metkevin.com/chat. You can tag me there at metkevin, and we'll see you in the next one. Thanks so much. Goodbye.